Hi everyone, Shaun Humphries here. In this presentation we're going to talk about how you can use your non-registered investments as a way of producing income through your retirement years and the role that these investments play. We're going to look at various asset classes or investment categories and how you can generate investment income from these categories and also how this income is taxed. You know, often when we think about retirement income planning and generating income, we think specifically about various forms of pension plans, whether those are defined benefit plans, defined contribution, our Canada pension plan, old age security benefits, and as well as income from our registered retirement income funds, tax-free savings accounts, life income funds, prescribed RIFs, etc. So there's a whole range of options that we can use to generate income. This particular video is going to talk about an option that's not talked about a lot, but it's a very important part of the retirement income planning equation for many Canadians, and that's non-registered investments. So to really get into this discussion, the first thing that I want to do is I want to go in and take a look at how various investments are taxed, because that's an important component of this discussion. So we're going to go to my website, www.shaunhumphries.com, and at the website there are a few different calculators that we can use to illustrate how various forms of investment income are taxed. Let's do that right now. Okay, now we're at the website. Again, www.shaunhumphries.com. And so on the home page, on the left panel, you'll see different categories on the navigation pane. And if you go to useful links and resources, you click on that, that'll take you to this particular page on the website. Got a lot of different calculators. There's a description for each one. I'd encourage you to go in there, take a look at each of the calculators, fool around with them. There's some really good little calculators that are very helpful. So if you look at, let's see here, inflation retirement income. So you can do an analysis to see how your income is negatively impacted over time because of inflation. And so the inflationary impact is looked at there. How long will your money last? So if you look at drawdown rates, inflation rates, and investment returns, it'll tell you how long an opening portfolio value will last as you begin taking money out. RIF calculator in terms of payment amounts from your registered retirement income plan, and TFSA versus RSP, an interesting calculator. So if you were going to make contributions to one of those plans but you couldn't do both of them, which should you do? And so the calculator will help you decide what is most tax efficacious for you. And we keep scrolling down. The one that we want to look at today is income tax. So estimate the taxes you will owe based on your taxable income in the province you live in. So let's just calculate that. Click on the tab, takes us to this tax calculator. And I live in the province of Manitoba, so we'll just click on Manitoba there. And the income we're using right now is $55,000. I won't change that. That's a default on this calculator. The marginal tax rate on that is about 33%. I won't go into defining marginal tax rate. We'll do that in another video. We look at the taxes payable. So when you plug the number in, it'll tell you the taxes payable. It's a rough calculator. But the important thing is these particular bar charts here. So what I want to do first of all is look at interest and salary. So as it relates to non-registered investments, if you have government bonds, term deposits, GICs, corporate debentures, mortgages, anything that pays a regular interest rate, these are typically your most conservative investments. Can include money market accounts, savings accounts as well. So we buy those investments often to be very conservative, very cautious, maybe it's short-term money, and we get interest income kicked out to us. If it's outside of a tax-free savings account, outside of a registered retirement income fund or an RSP, you'll get a T5 or a T3. And you can see here that interest income is taxed at the highest rate. So whatever level of income you're at, if you're at a marginal tax rate of 33.25%, that income is going to be taxed at that level. So at the highest rate, there's no tax advantages attached to interest income. Capital gains income, you can see that the marginal rate is lower. It's 16.63%, so a huge difference between interest income and capital gains. Well, what kind of investments provide capital gains? Well, a couple of obvious examples would be I could buy a common stock or mutual funds. And actually we could add real estate to that example as well. But let's say we put $10,000 into a stock mutual fund or individual stocks. Those investments grow to $20,000. We then sell it. The difference between the 10 and the 20 is a $10,000 gain. Of that $10,000 gain, 50% is taxable. So $5,000 is taxable. When you go through that calculation, that ends up being a 16.63% marginal tax rate, much lower tax rate because only 50% of the gain is taxable to you. And so very powerful. The other advantage of capital gains is that no tax is triggered until you actually sell the investment. And so as long as you just defer and defer and defer, it'll keep compounding and growing without you having to pay tax annually. Whereas with interest income, as the investment grows and as you receive income, you've got to pay tax annually every single year on the earnings that you've accumulated. So if you're trying to grow your capital, particularly for retirement, or you are retiring and you have some money that is not needed to be delivering income to you in the next number of years, focusing on capital gains could be a real advantageous strategy. And then we have eligible dividend income. And dividend income is income that's being paid out ultimately by preferred or common shares of publicly traded companies typically, and they'll pay a quarterly dividend. At the time of this video, a lot of bank stocks were paying dividends in the range of 4 to 5%. So you could buy Royal Bank or Scotiabank or CIBC or various financial service companies. They'll pay you a 4 to 5% dividend. It's paid quarterly through the year. And the government has set up a tax structure to allow for some beneficial treatment around dividend income. So again, interest income, what was it? 33%. If you've got the same level of income but in the form of dividends, it's taxed at 14% if our total income is in around $55,000. So it's very important we understand the mechanics around this, because as it relates to retirement, if you're trying to get your money to last longer and to work much more productively for you, you need to be aware of the tax impacts. Now, within a tax-free savings account, within RIF plans and RSP plans, you don't have to focus on this as much because all the growth is either tax deferred or it's tax-free. But the minute you're investing outside of those vehicles in an open or non-registered portfolio, you're going to get interest, dividends, and capital gains. You want to structure a portfolio that will allow you to take advantage of the beneficial treatment from a tax standpoint of these various investments. Okay, so we've talked a little bit about how the income is taxed from our portfolios when outside of an RSP or other registered or tax sheltered accounts. So we have interest income, which is fully taxed, then we have capital gains. Capital gains is tax preferenced and a much lower rate because 50% of the gain is tax-free and the other 50% is taxable. The other benefit around capital gains, like I said, is that as you hold the asset, you're not having to accrue tax every year. So if you grow at a rate of 3% or 5% or 10% a year, it keeps compounding at that rate potentially, and no tax has to be paid until down the road when you actually sell the investment. Most accountants will say, listen, a dollar deferred, in most situations, a dollar deferred is a dollar gain. In other words, if I have tax that would normally be paid today, but I can defer that tax bill 10 years into the future, where I'm paying with dollars that are worth less because of inflation, I'm better off to pursue that strategy. So capital appreciation is one way of doing that, buying investments that will appreciate in value without having to be taxed every single year. Like I said, once you do sell the investment, then it is tax preference. And then the last category was dividend income. And dividend income is tax preference for various reasons, and the Income Tax Act has been structured that way. Suffice it to say, if you have investments like preferred or common shares or investment funds that pay dividends, they'll usually have a reasonable amount of tax preference. And so it's one way of structuring a portfolio so you're not paying more tax than necessary. Okay, that's a broad overview. One more comment about taxation. We actually will have a separate videos that will deal with these topics in more detail, but the first thing I would say is make sure you're aware of what are referred to as corporate class investments, and I will talk about those in a minute, and then what are called systematic withdrawal investment plans. So that's a strategy of taking out a regular consistent income, usually on a monthly basis, from an investment portfolio, and that systematic payment will give you some tax preference because it ends up being structured in such a way that the income coming out is a combination of capital and some earnings. So obviously capital, the capital portion is either non-taxable or tax preferenced, and so as a blended payment of capital and capital gains, which is tax preferenced, and then maybe a bit of interest and dividends, the overall tax bite to produce the income from the non-registered portfolio would be far less than if you're just taking income as dividends or interest from your portfolio. And then the corporate class structure, that's a way of investing money so you get some tax preference. I'm going to spend a few minutes right now just talking about that a little bit. It's a very important strategy as it relates to your non-registered portfolio. Okay, what you have in front of you on the screen is a white paper document on corporate class investments. So linked to this video will be this particular information. It's a great overview on how corporate class structures work. And so I'll quickly go through this, and then you can take a look at the information after the fact. You can download it from the website, and then you have it as some information you can reference. But how can corporate class be used? It can be used to minimize or eliminate annual distributions from your portfolios. It reduces taxable income. It's a tax-efficient way of leveraging off capital gains and dividends. Some of the advantages to corporate class in the last federal budget have been reduced, but it still is a very beneficial structure. So to rebalance your portfolio on a regular basis without triggering capital gains or losses. So that was part of the corporate class structure prior to the last federal budget. That's been nixed. But the ability to get tax preferenced income from the structure is still available, and I'll talk about that in a second. Who uses this structure? Well, again, if you've been maximizing your RSPs, maximizing your tax-free savings account opportunities, then you might consider this structure. In particular for higher income earning Canadians, it's beneficial, and it can be a way of reducing the potential of clawback on your old age security benefits by reducing the amount of taxable income that will be generated by your portfolio. Corporate class investments could be an ideal strategy for those of you who are incorporated and are building up retained earnings within your corporation, and they might be sitting in investments or cash assets. The challenge with corporations is that if you can build up too much in the way of retained earnings in passive assets or investments, potentially the earnings off those investments could be taxed at the top marginal tax rate. So corporate class investments are a way of building up assets within your corporate structure, but because it greatly reduces the amount of distributions, taxable distributions from the portfolio, you won't be hit with additional taxation within the corporation on these assets. So again, if you're self-employed and you've got a corporate structure, you want to take a serious look at the corporate class investment structure. And then we have a case studies that you can take a look in terms of how corporate class have been used. So in this example, I'm using a corporate class structure with CI investment funds, and the illustration that you have in front of you just kind of goes through a broad kind of overview on the difference between corporate class and, let's say, a regular mutual fund. So with a mutual fund trust, under the Income Tax Act, your mutual funds will pay out all distributions. A mutual fund trust is considered an intra vivos trust, and under the Income Tax Act, if the income is not paid from the trust, it's then taxed at the top marginal tax rate. So it's beneficial to investors to have the income paid out and then taxed at whatever their marginal tax rate is. So a mutual fund will pay its distributions. You would get a T3 or T5. Typically those distributions are reinvested back into the investment structure to buy more units of that investment fund. But you could apply the same thing to a portfolio made up of individual stocks paying dividends. The dividend income is reported to you in a T3 as an example. You pay tax on it, so there's no way of sheltering that income. With a corporate class structure, the way it's set up is the income that's generated within the corporate class structure, whether it's interest income, dividend income, or capital gains income, is not going to have to be paid out necessarily. So what the corporation does is it takes a look at all of its income from all sources. It'll have expenses, it might have some losses, and at the end of the day, when they go through the calculation, there may not be any taxable distributions that have to be paid out to the unit holders of those investments. What's very unique about the structure is that if you look at your own portfolio and you file a tax return, a T1, if you've got interest income or dividend income and capital losses, you can't use losses to offset the income on dividends or interest income. The only place you can use losses to offset investment income will be capital gains. So if a capital gain that's taxable, if I have losses that I've been carrying forward from previous years, I can use those losses to offset the capital gain. But that's the only place you can do that on a personal tax return. With corporate class investments, we could literally have something like interest income predominantly or dividend income. The structure would likely have some expenses or losses that they can use. So at the end of the day, from a tax standpoint, there's no taxable distributions that have to be paid out. So if you earn 6%, you compound at 6%, you didn't pay tax on the income. It's a very powerful strategy for conservative portfolios. If you have an income mandate, very conservative portfolio, let's say it's earning 3, 4% or 5%, If it's taxable income, you're not keeping a lot of money on an after-tax or after inflation basis. With a corporate class structure, you could earn, let's say, 4 or 5. Let's say we're really conservative, it's mostly interest income, but you'll compound that whole amount in your portfolio. You won't be paying tax on the full amount of distributions each year. So in this example, we had $50,000 that was invested in the portfolio. We reinvested all income. And with the mutual fund trust, which is the line here, kind of the gold color, you're having to pay tax every single year. And at the end of the 30-year period, that portfolio would have grown to approximately $183,998 on an after-tax basis. And then if we look at the corporate class structure, same $50,000 invested, and then when we get down to the end of the 30-year period, that portfolio is $232,632, a significant difference in after-tax value. So, the longer time frame the structure is in place, the more beneficial, but there are year-by-year benefits that the corporate class structure can provide. So when we're building a portfolio for retirement, we need to obviously, first of all, decide, what kind of returns we need to aspire to, what risk level we feel comfortable with, and decide what level of income we may have to generate from the portfolio. But we also need to take into account how the various investments are taxed. And tax is not something to be laissez-faire about. It can be a very large expense to your retirement cash flow. So anything we can do to reduce that tax bite obviously is beneficial. So for a lot of clients, they're so busy doing stuff that this isn't an area they drill into maybe as much as they feel they should. They're just busy. And so one of the roles that we play with clients is trying to structure these income portfolios from their non-registered assets in a tax preference manner. Okay, so that's the corporate class structure. Now what I want to do is I want to go to our actual software application and show you how we use this information to begin modeling different income streams and how we build that into the overall retirement income plan. Okay, what you see in front of you is just the home screen for our financial planning application. This is a very powerful software application that allows us to take every aspect of a client's personal circumstances financially, and both personally and corporately if they have business assets, and to take into account pension plans, government benefits, RIF accounts, RSP accounts, tax-free savings accounts, non-registered capital, and then integrate all those different areas into one holistic forecast for retirement. It literally allows us to model every single year through retirement, build in inflation returns, different investment returns, different drawdown rates on the portfolio, so that the client can actually simulate, at least from a number standpoint, what retirement will look like. So we confirm whether they can sustain the income that they are shooting for retirement, and then secondarily, what's the impact to their balance sheet or net worth statement as they draw down that level of income. The biggest concern that clients have is not wanting to outlive their income. They don't want to have more life than income. That would be a disastrous situation for them. So the idea of being able to maintain long-term financial independence is critical. Once that question is answered within the context of the assumptions used, then the secondary question is, okay, I know my income is going to be looked after. Are there any legacy planning or tax planning strategies that I can initiate that might help family members, grandchildren, communities, charities, that kind of thing? So let's take a look at the module that reviews the investment planning piece. So before we do that, I'm just going to show you something very quickly. So this is a forecast for retirement income planning, and just to kind of give you some context for this, this is a chart looking at roughly, I think, $60,000 of income a year. That's the green line. It's hard to make that green line out, but there's a husband and wife. The brown bar and the yellow bar represent all their sources of after-tax income. And as we model this out from the current date, age 59 through to age 90, they had no deficits or shortfalls in their long-term income planning. Their net worth statement is something they wanted to be aware of as well. And so this particular schedule or chart that I'm going to show you looks at their net worth statement over those years. So you can see here that as they were spending that income, their net worth pretty much held constant. The green is real estate, the blue is non-registered portfolio value, and you can see that the different blues here: tax-free savings account, pension assets, RSP assets. So it's a great visual representation of how their assets will change using various spending patterns. Now, when we did this analysis, the assumptions we used was a 4% return on the overall portfolio, and we used a 2.5% inflation rate. Now, practically speaking, how this has an impact is that on the portfolio, we assume that that 4% rate would happen. It would be all interest income, and it allowed us to model the financial planning. The way we started that is you go into their non-registered portfolio, and let's go to non-registered assets. Here's the client. Go into data entry. They happen to have $250,000 in portfolio value. Now, what I tend to do is particularly for the non-registered portfolio, I will tend to put everything into cash or cash equivalents initially in the first model. So that might be, GICs, term deposits, money market accounts, T-bills, very conservative investments. And we'll then model their retirement income plan to see whether they can actually reach their financial goals using a very conservative investment strategy, paying full rate tax. So remember previously we talked about how interest income is taxed at the top marginal tax rate. If they can actually reach their long-term goals using that assumption, then that gives the client a lot of maneuvering room. I mean, the basic motto that I have in retirement income planning is don't take on more risks than is necessary for you to achieve your goals. Well, if you can get a 2.5% or 3% return, mostly interest income, and still reach your long-term goals, that's a great outcome. There's no need to take a lot more risk. Now, some clients from just a fiduciary or stewardship standpoint will go, listen, if there's opportunities in the Income Tax Act to get some tax preference through capital gains or dividend income, I want to have a portion of my portfolio allocated to that. And that would be something I'd strongly recommend, particularly for those assets that may not be needed for another 5, 7, 10 years. I think there's a lot of flexibility in building portfolios that have a balance between interest income to be conservative, but tax preferenced income through dividends and capital gains to maintain the purchasing power and the real compounding power of the portfolio over time. But you can see when you do the data entry, I can put in the percentage in bonds, in foreign investments and bonds, equity investments in Canada, U.S. equity, foreign equity generally. We also put in the adjusted cost base, which is often referred to as the ACB, and that's the number that gets used to calculate the capital gains in the analysis. The difference between ACB and the current market value will determine what level of tax is triggered each year in the retirement analysis. So with this cash equivalent investment, this is what the portfolio looked like over the years. You can see that in the early years of retirement, the client was peeling through quite a bit of income, and then later on, not as much income was being needed here through the early 69, 70, 71, and then over time the income started going up again. In terms of the actual value of the portfolio, it was fairly static through most of those years, so not a huge change. When we look at the actual portfolio itself, in terms of the schedules, you can see the growth each year. This is a forecast of 4%, but of course we can use different models for clients to stress test their retirement income planning. You can see here they began taking income in the 61st year, put pressure on the portfolio until their old age security benefits kicked in. Then they were taking less income from the portfolio. It also gives us an idea of the growth in the portfolio every single year, so the client can see the impact of that. So this is where we marry this generic discussion on how's investment income taxed, do we use corporate class, don't we, can we afford to be conservative in the open portfolio, should we emphasize investments that have some capital gains or dividend income. We marry all those ingredients together to begin modeling what the retirement plan will look like. And again, like I said, if you can be conservative and still reach your goals, great. We can use mostly an income portfolio or a more conservative portfolio. If you are having to run a balanced portfolio and reduce the tax bite, then that's where you need to start looking at strategies that will do that for you. So let's leave this particular schedule. And so that's really the main points that I wanted to cover off in terms of the computer simulation. These tools are very powerful. I find that a lot of times people will start planning for retirement, or they'll be in retirement and they're doing various things, but they're not aware of the ripple effect in their planning as they draw down assets from various sources. And so we really like to model these plans for clients. For many clients, we're doing it yearly. Certainly I recommend every 2 to 3 years for sure, and it just allows you to pull all the pieces together as you're doing your retirement income planning. And really your retirement plan will help to define the investment strategy. It shouldn't be the other way around. You should not be making investment decisions in a vacuum. Well, I think you'll agree that we've covered a lot of material on one very specific topic within retirement income planning, and that's a general discussion on how our non-registered investments play a role in generating income for our retirement. So we talked about the tax impacts, the importance of modeling the various investment options that we have available to us. Now, you might be a do-it-yourselfer, and you've maybe found this information helpful, and you're going to take it and you're going to run with it. For many people viewing this video presentation, quite frankly, the nuts and bolts about how to pull the pieces together are a little bit daunting for you. So if that description fits you, then I think you'll want to take advantage of our process called Game Plan. We've developed a specific process for people who are getting ready for retirement, and maybe you're already retired and you want confirmation you're doing the right things for your retirement income plan. So whether you're in accumulation phase, just at the runway about to retire, or retired, this process could likely be very helpful for you. What we do is we have a process that helps you get clarity in your current situation, what your goals are. We use our financial planning software to model your retirement income planning, and then we provide you with some very specific direction on your, whether it's tax planning, investment planning, cash flow funding, estate planning, to make sure that you're feeling comfortable that you're doing all the things necessary to be on track to reaching your goals. As well, we put together what we call an implementation proposal to give you very specific ideas about how you can begin moving in the direction of that financial plan and actually putting it into action. So if you're interested in getting more information about Game Plan and the process, here's the contact information. You can contact our office directly at area code 204-977-8022. My address, email address is humphries@assante.com. And be sure to poke around our website. We've got a lot of helpful resources in the area of retirement income planning and other financial topics at www.shaunhumphries.com. And our process really is, if you're interested in getting more information, we have some white paper documents, we have information on Game Plan, and we'd be happy to arrange for a no obligation phone consultation to explore whether in fact our process is right for you. So I wish you all the best in your journey towards wealth creation, wealth preservation, and enjoying the lifestyle you desire as you plan for a successful and happy retirement. You take care.